Welcome to the JD Capital Podcast, where we help property investors and homeowners confidently navigate their way to financial freedom. This is Jai Kao, your host, where we'll unpack everything there is to know about wealth building and financial literacy. Happy listening. Welcome back to the JD Capital Podcast. We've got Aaron and Valley joining with us. And today we're going to go through some of the biggest mistakes that we see property investors make. So, Aaron, I'm going to throw to you.
Yep.
Tell us, what are some of the mistakes or things that you're hearing that people are afraid of in the beginning?
Look, with new investors, I think a lot of the time it's been too rate focused. And I'm sorry to say, it's not only investors, sometimes it's other mortgage brokers as well. But it's definitely something we notice. And I say it's a mistake because an interest rate is a cost of business when you're investing in property. It's an expense that, unless you've got heaps of cash, you have to deal with. It's not the primary focus. So if you're buying property for investment, the focus is to generate wealth. So the interest rate is just a cost of doing that. So I think, we often see people getting a little bit too focused on that, where they may try and make a decision, to buy the wrong type of asset at the wrong price point because, they can service with a tier 1 lender instead of a tier 2, for example. That's a big one that I see a lot.
I totally agree. It's what a lot of people are accustomed to look at first, right? When they look at going to borrow money, is what is the interest rate? And I totally get it, right? Because when you're borrowing money, it sounds like it's a lot of money that you're borrowing and you've got to repay the debt as well. But if you're an investor, your goal should be a little bit more different. It should be focused more on growth. And that's where people can take advantage of using a tier 2 or tier 3 bank, pay an extra 1%, 2% at most, I'd say. And if you look at what happened in the last 2 or 3 years, Perth and Brisbane both had double-digit growth, right? 11%, I think it was, last year. So if you paid an extra 1% or 2% on the mortgage and you're getting 10% growth on the property, it's a pretty good deal.
Absolutely.
And you're not stuck with that bank forever.
Yeah, that's right. That's exactly right, Jai. I was going to say I'm not great at maths, but that one really worked out for me.
Yeah, it's just got to illustrate it in that way and then people understand, right? They're like, oh, why am I paying extra rate? Well, it's because you couldn't have bought that property without that bank.
Yeah.
And I like that point. It's a cost of doing business.
Absolutely.
Right.
And I think when you look at the difference between, 0.5% of an interest rate, it's not that significant, really. Like we're talking maybe a couple of grand a year on a $500,000-$600,000 investment. Go and add up how much money you're spending on coffee every week. It's probably more. So, perspective, long-term thinking.
Okay, so the biggest learning there is don't focus too much on the rate itself. Focus on the opportunity cost and the growth.
Absolutely, yeah.
Great. What else do you see? What are some other common things that you guys see as mistakes or challenges that new investors go through?
One of the ones I've actually seen a little bit, not all the time, but I've had people that have come up to me and they've said, oh, my friend who's in my work, not necessarily in finance or broking or investing, they said, don't buy now. Interest rates are too high. I know we're coming back to the rate thing, but getting advice from the people that are not with their finger on the pulse can really lead you astray. That would be one of the things I hear all the time.
Yeah. And I think that goes back to don't take advice from people who haven't done it before.
Yeah.
Right? Like find a mentor, and that mentor doesn't have to be someone super successful. It just has to be someone who's done what you want to do. And if you can take a learning from someone who's had experience, then you're most likely going to be better off than not doing anything. But I like that point, right? Not taking advice from someone who's completely have no experience.
Absolutely.
Yeah, because it's all rumor.
Never take cooking advice from me, but Aaron, no problem.
Or me.
Only if you want to make rice, I'm really good at that.
Yeah, that's
Not
true.
much else. Yeah. That's true though. When Valentin and I first started investing, one of the biggest reasons why we picked the buyer's agent that we picked was because he'd been there, done that. He had a massive portfolio and he really gave us confidence that he knew what he was talking about. Don't take advice from well-intentioned family members that don't know what they're talking about.
Yeah. if I go back in time, I would not listen to my parents' advice. Yeah, it's funny, right? Parents tell you good things, but then they don't know a lot about property investing.
Yeah.
And Dad was like, "Don't buy in Brisbane." I'm like, "Okay, Dad, you never bought in Brisbane."
Didn't you take him there after you went against his advice?
Yeah,
Yes,
yeah.
you did.
Now he's looking back, going, "Oh, okay, maybe you should have bought more there."
Oh, yeah. Should have bought more, Jai.
Yeah.
You know, it's funny. Something my dad says, debt. That's his big thing.
Yes.
Debt's terrible. You never want to be in debt. Don't be in debt.
Let's talk a bit more about debt. Yeah. So why do you think people are so afraid of debt?
Look, I think it's just an entrenched attitude that people have, that debt is bad. You know, I think we all follow those underlying beliefs that we're raised with, right? And you might not even consciously realize that you're going with that, but you're surrounded by it growing up, similar to your parents, right? They're like, don't buy here because of this. It's the same thing. Look, debt can be terrible. If you're getting into debt on depreciating assets like cars or, you know, expensive hobbies and toys and things, that can be bad. But if you're getting into debt to buy assets that are going to go up in value and that are going to produce an income for you, it's actually not only that debt is not bad, it's actually essential. You cannot build a decently sized property portfolio without using debt. You have to have it.
I really agree. And I think that's a really big mindset shift that a lot of people will need to adjust, because when you're looking at building a property portfolio, you're not looking at just buying one property or two properties. It could be 3, 4, 5 or whatever you need to get to your goal. And when you're doing that, you're scaling, right? And when you're scaling, you need to leverage off someone else's money, and that's going to be debt. I think that's where people need to be comfortable with debt. And I think the biggest learning from my perspective is that debt becomes less relevant when there is better cash flow, because the cash flow is paying for the debt, right? And the value of debt is money. It decreases over time, right? But the asset's increasing in value, and then you've also got an income that's also increasing. That clicked for me when I started to see that, but it took a while. And I think that's how I started becoming more comfortable with debt. But I can understand a lot of people when they start out, they get more scared because they're like, that's another loan and another loan. You're taking equity out on another loan. And it can feel scary, especially if you've not had a good relationship with debt in the past. Yeah.
I think a remedy to that is actually another common mistake that I see, particularly from new investors, and it's not paying enough attention to budgeting. Rather than being concerned with not taking on debt, I think what you should be concerned with is budgeting, but also stress testing your portfolio. And what I mean by that is, all right, if interest rates are 6% right now and you're looking at buying, you should be budgeting to see what your life is going to look like if interest rates go to 8%, right? Or maybe even more. And the banks do that for you when they assess a loan. Most of the major lenders, well, the major lenders add 3%. Some of the small lenders add a little bit less, but they do stress tests for you. But you should be doing it for yourself and keeping cash reserves. So do your budget, know what your expenses are, know what your income is, and keep some cash in an offset account so you can respond to things that might happen. You might lose your job, you might have vacancy rate in the property, interest rates might go up, stuff like that.
100%. And no one goes bankrupt if they have good buffers, right?
No.
If you've got a good buffer on the side and you've got good cash flow, good budget, you can't go bankrupt. Right? Where it gets really risky is someone doesn't have a good budget and they've got no buffer and something really bad happens and they lose their job, for example, and the rent doesn't cover the mortgage, then of course they're in big trouble. They've got to sell, right? That's where people get caught up because they don't have the budget. Right? I know it's not sexy, but doing the budget, doing the numbers is really important because no one goes bankrupt if you have a good, good buffer on the side. I think successful investors manage risk really well. And if you can manage that risk well or minimize the risk, the less chance of things going wrong.
Absolutely. Yeah, definitely.
Yeah.
Jai, you said something, if I can ask. So you mentioned cash flow just before. We've had a few times where some of our clients are looking or chasing negative gearing. What are your thoughts on that in terms of, because I think that relates quite well with cash flow. And they're like, oh yeah, but negative gearing.
Yeah, look, negative gearing is something that's really good in Australia because any loss on the property can be offset on the income, but you usually don't get it back until the end of the financial year. So you've got to wait a full financial year before that depreciation or even negative gearing kicks in. But it's something that can help cash flow, right? And I see it as a bonus because most of the time in the beginning, the first couple of years, you're always going to be negatively geared, right? Unless you had a significant deposit. Right, but I don't think we should be chasing negative gearing. It's just a byproduct of investing. And over time, every year, whatever loss you get, that comes back as a tax refund. I just treat that as a bonus, right? Goes back into the offset account or goes back into reinvesting. And I think that's a great way to reduce your taxable income, but also improve the cash flow on the property side.
So not something probably to chase, but as a consequence, if it's there's a way that we can sort of force savings.
That's right.
We can get some of that back.
Yeah,
Oh,
that's
good.
right. There's also something called PAYG variation. So it means if you know that you are going to be negatively geared quite significantly, you can set something called a PAYG variation with your accountant. And that basically means you pay less tax up front and you get your net income improves. So ultimately your cash flow is better. That can help you manage the cash flow instead of waiting for the tax return to come back. So that's also another strategy that I see quite common, especially in the last 12 months and 24 months with people having really poor cash flow with the high rates. So again, it's all about cash flow management, looking into the different strategies on what you can do to improve that. What else are you guys seeing? Any other challenges in terms of investors? Trust structures is something that I think comes up quite a fair bit these days.
Yeah.
I think you've been working on quite a stressful deal for one of our clients.
Yes, we did. I'm not going to name the bank, but we got in a fight with them. We won.
We did.
Loan got approved.
Yeah.
It was a few days of to and fro. The bank trying to figure out what their own policy was on
Yeah.
trusts and commercial income.
So that was quite a complex scenario where we were using trusts and we had property in personal name, cashing out equity from an owner-occupied property.
Yes, we
So
had
everything all in the
commercial
one.
property as
Commercial,
well. We had
debt
maternity
recycling,
leave. We had
everything.
debt recycling. It was literally like all in one. Look, I think we do sometimes see people wanting to use a trust because it sounds sexy. They have their place, but I don't think as a blanket rule that a trust is a great idea to own a property, and it really is circumstance specific. And a lot of that comes down to what your goal is. And I know it's a really hard question to ask someone when they first approach us. What's your goal? What do you want to achieve in 30 years? But it's important for us to know as best you can tell us what it is, because if your goal is, I want to buy a house to live in, but you might be buying some investments first. We need to consider that because we need to preserve your borrowing capacity. So in those circumstances, all right, maybe a trust is a good idea. Or there's a bit of an asset protection argument for trust as well. But there's downsides to these things. You lose your negative gearing benefits. They're a little bit expensive to maintain. It's not all good news. So I think we do sometimes see people turn up with preconceived ideas. I heard a trust is a great idea. Heard this is a great idea. That's a great idea.
Is that from their panel of their family?
It
Their
might
experts?
be, maybe. My answer to you is they're all good ideas and they're all bad ideas. It just depends on your circumstances.
Yeah, and I agree. I think people really need to look at the pros and cons of why you're buying in a trust and get some advice, not just take someone's advice when they haven't really, or they're not really, I guess, a professional to give you that advice, right? So if it's from a buyer's agent, you might want to go seek an accountant to get that advice and understand what's the pros and cons of the trust. Because I agree, it's not right for everybody. You have to use it for the right reasons as well.
Yeah.
Agreed. Opinion and advice, very different.
Yeah. All right. Well, I think we've covered off everything, and really good to share some of the challenges that we're seeing in the first quarter of 2025. And we look forward to sharing some more stories later this year.